I'm Gary Hemming from ABC Finance, and in this video I'll be breaking down everything you need to know about bridging loans in a short, condensed and easy to understand way. We'll look at what a bridging loan is, how they work, how bridging loan interest rates work, and some key considerations prior to taking out a bridging loan. A bridging loan is a type of short-term loan that is secured against property and is generally used to fund a period between two events happening, for instance purchasing a property and another one selling. Bridging loans are often used to purchase property at auction because they can be arranged very quickly. They're used for property refurbishment projects and to purchase a property before selling your existing home. Bridging loans work slightly different to mortgages, but they're fairly simple once you understand how they work. A bridging loan is secured against a property and interest is charged monthly and is often added to the loan, leaving you with no monthly payments to make. The bridging loan then runs for a set term, usually 12 months, maybe 18 months, and at the end of the term it is repaid through what is known as your exit strategy. Exit strategies will be covered later in the video and we'll explain exactly how that works. As mentioned earlier in the video, bridging loan interest is charged monthly, which is unusual compared to say mortgages or personal loans, which commonly come with annual interest rates. Bridging loan interest is then charged monthly and is often added to the loan or retained, leaving you with no monthly payments to make. Should you choose to repay your bridging loan early, the interest is usually only charged for the period that the money's been borrowed. So if you borrowed a bridging loan for an 18-month term, repaid it after 6, although you've agreed to 12 months interest, only 6 months would usually be charged. If 12 months has been added to the loan, it's usually rebated to you when the loan is repaid. One of the key factors when taking out a bridging loan is how you will repay the loan. This is known as your exit strategy. The exit strategy is one of the key things that bridging loan lenders look at prior to approving a loan, but it's also one of the most important factors for a borrower to consider. A bridging loan, as mentioned, is a short-term loan, and your method of repayment is the thing that will keep you safe and avoid running into any issues with your loan. Common exit strategies include sale of the security property, the property that the loan is secured against, refinance of a property, either the security property or another property, sale of a different asset such as another property that you own, an investment property or an expensive asset, or cashing in investments that you may hold or money that's due to you, such as an inheritance. Bridging loans can be arranged very quickly, usually in somewhere between 5 to 21 days. The speed that you take out a bridging loan will depend on the type of transaction, so what you're actually doing with the money, and the type of security offered, plus the lender that you choose. Some lenders can complete very quickly in a matter of days. They tend to charge higher interest rates. So there is often a trade-off to consider between the amount of interest that you're willing to pay and how quickly you need the funds. Now we'll take a look at some of the key considerations that you should look at before taking out a bridging loan. As mentioned earlier in the video, the first and most important factor is your exit strategy. Never take out a bridging loan without knowing exactly how you'll repay the loan. So if you're looking to sell a property, for instance, consider how long the property will take to sell, how wide a pool of buyers you have. If you're refurbishing your property, is there a risk that that could overrun? From there, consider backup options. So if you can't sell the property, is there an option to refinance? Look at letting the property. Could you refinance to another bridging loan? Are there other alternatives available? And finally, look at how best to find the best bridging loan for you. Using a specialist broker, while it may add to the cost, can significantly add value. It's not always easy to compare products without using a broker, and many bridging loan lenders price loans individually. So a specialist broker will have immediate knowledge of the market, ensure that you're using the right lender for your needs, and will also look at those other considerations such as what happens if things don't work out, work on backup plans, and if finance is needed for your exit strategy, may be able to line that up front to make sure that you're absolutely covered. Thanks for watching our bridging loan video. We've covered quite a lot of ground in quite a short time, so I hope you found it valuable, if not maybe slightly overwhelming. If you have any questions or you want to know more, check out our website, abcfinance.co.uk. There you can get in touch with us, ask us a question, or even get a quote, talk to our experts, and we'll be more than happy to help.